Hey traders, welcome back to Trader Shastra. Two Nobel Prize-winning economists, part of the smartest trading team ever assembled in history, lost $4.6 billion in just 4 months. All because they broke their own trading rules. If literal geniuses armed with Nobel-level mathematics and sophisticated models couldn't survive when they bent their rules, what makes you think you can? There is only one thing that truly separates consistently profitable traders from the 90% who eventually blow up their accounts: absolute, unbreakable discipline. Not 95% of the time, not most of the time, 100% of the time, or you might as well not have a system at all. Let me ask you something straight up. Why do most retail traders lose money? Is it because they're stupid? No, many losing traders are doctors, engineers, highly intelligent people. Is it because they don't work hard? No, most of them study charts for hours every single day. Is it because there are no profitable strategies? Absolutely not. There are dozens of proven strategies freely available right here on YouTube. So why do they lose? Because they either don't have a real system or they have one, but they abandon it the moment emotions take over. They learn a strategy, they test it a few times, it even works, then real money is on the line and suddenly the rules go out the window. This time is different. I have more information now. My gut is telling me to hold longer. I'll just move my stop a little further, it's definitely going to reverse. And just like that, they stop trading a system and start gambling. Decisions based on hope, fear, and ego instead of logic and probability. Think about how casinos make money. Casinos don't win every hand, they don't win every spin of the roulette wheel. But over thousands and thousands of spins, their tiny mathematical edge turns into massive profits. Why? Because they have a system, pay out less than the true odds, and they follow it robotically. They never get emotional after a big loss and chase it back by changing the rules. They never look at a high roller and think, let's give him better odds to be nice. They stick to the system without deviation, without exception. As a trader, you need to be the casino. Your system is your edge. Your discipline is what allows you to collect that edge over time. But the moment you break your rules, the moment you make a discretionary decision based on feelings, you flip sides. You become the gambler sitting across the table from the casino. And gamblers always lose in the long run. So what does a real trading system actually look like? It's not vague advice like buy when it looks good or sell when you feel nervous. A real system has 4 non-negotiable pillars. First, entry rules. Objective, crystal-clear criteria that tell you exactly when to enter. No interpretation. No, it feels right. If X, Y, and Z are met, right arrow enter. If not, right arrow sit out, period. Second, exit rules. Both your profit target and your stop loss defined before you ever click buy, not I'll figure it out later. You know exactly where you're getting out, win or lose, before risking a single rupee. Third, position sizing rules. A fixed percentage of your account risked per trade, never I'll risk more because I'm really confident this time. Same risk formula every single trade. Fourth, trade management rules. What you do while the trade is open, do you trail stops, take partial profits, scale in, all decided in advance and executed mechanically. If you're missing even one of these pillars, you don't have a system. You have guidelines that you'll abandon the second you feel uncomfortable, which is exactly when you need your system the most. Now let me tell you the most expensive trading lesson in history. The story of long-term capital management, LTCM. In 1994, a hedge fund was launched with the ultimate dream team of finance. John Meriwether, legendary bond trader from Salomon Brothers. Myron Scholes and Robert Merton, who later won the Nobel Prize for their options pricing model. Former vice chairman of the Federal Reserve. A whole army of PhDs in mathematics, physics, and economics. These weren't gamblers, these were the smartest quantitative minds on the planet. They built sophisticated mathematical models to find tiny price inefficiencies in global markets, arbitrage opportunities that normal people couldn't see. And for the first few years, they were untouchable. 1995, 43% return after fees. 1996, 41% return. 1997, 17% return. They had almost $5 billion under management, leveraged 25 to 1, controlling over $120 billion in positions. Banks were begging to give them money. Their system was built on Nobel Prize-winning math. It was backtested, it worked. But their system also had strict risk management rules, position sizing limits, leverage caps. And in 1998, they broke those rules. Russia defaulted on its debt, global panic, investors ran to safety. LTCM's models predicted that certain bond spreads would quickly converge. They loaded up massive positions betting on that convergence. But instead, the spreads widened dramatically. Their math said it was temporary, and they were probably right in the long run. But because they had become overconfident in their genius, they had pushed leverage way beyond their own risk limits, some estimates say over 50 to 1. When the market moved against them, margin calls came fast. They couldn't meet them without forced selling. That forced selling pushed prices even further against them. Other hedge funds smelled blood and actively traded against LTCM's known positions. In just 4 months, May to September 1998, LTCM lost $4.6 billion. Not because their models were wrong. Not because they were stupid. They lost $4.6 billion because they broke their own risk management rules. They thought their genius-level understanding meant they could bend the rules this time. This time is different. Sound familiar? The Federal Reserve had to organize a $3.6 billion bailout with 14 major banks because LTCM's collapse threatened the entire global financial system. Let that sink in. 2 Nobel Prize winners and the smartest quants in the world destroyed everything because they trusted their judgment over their own rules. If they couldn't survive breaking their rules, you definitely can't. Now, most traders think breaking rules just costs them the money from that one bad trade. But the real costs are much deeper. First, the immediate cost, bigger losses from moved stops or overleverage. But that's the smallest part. The psychological cost, when you break rules and lose, you don't know if your system is broken or if you just didn't follow it. You can't improve. When you break rules and win, it's even worse. You reinforce the wrong behavior. Your brain learns, see, trusting my gut works. That's how discipline slowly dies. The opportunity cost, every emotional trade wastes capital, time, and emotional energy that could have gone into perfect system trades. And the compounding cost, trading is a game of edge compounded over hundreds of trades. If your system has positive expectancy but you only follow it 70% of the time, those 30% emotional trades destroy your edge. Over years, that's hundreds of zero-edge gambles killing your profitability. So how do you actually build unbreakable discipline? It's not about willpower. Willpower cracks under pressure. You need structures that make rule following automatic. Step 1. Build trust through deep backtesting. Test your system on hundreds of historical trades, not 5 or 10. When you've seen it work and lose correctly over 300 trades, it's easier to trust it when emotions scream at you. Step 2. Forward test on demo with zero tolerance. At least 50 trades. If you break a rule even once, start over. This proves you can actually follow it before real money is involved. Step 3. Use a physical pre-trade checklist. Before every potential trade, go through a written list. All entry criteria met. Stop loss and target placed exactly per system. Position size calculated correctly. Am I emotionally neutral? If any answer is no, right arrow, no trade. No exceptions. This pause interrupts emotional impulses. Step 4. Journal discipline, not just profit. After every trade, rate yourself. Followed entry rules, yes, no. Followed exit rules, yes, no. Followed sizing rules, yes, no. Any emotional interference, yes, no. A losing trade with perfect discipline is a win. A winning trade where you broke rules is a failure. Step 5. Redefine success completely. Success is not making money today. Success is not being right about direction. Success is perfect execution of your system for 100 trades in a row, taking every valid signal, sitting out every invalid one, no matter how you feel. When you measure yourself by what you control, your discipline, instead of what you can't control, market movement, everything changes. And here's the final mindset shift you need. Stop seeing yourself as a trader trying to outsmart the market. Become a system executor. Your job is not to predict, not to be clever, not to use judgment. Your only job is to flawlessly execute what your system tells you to do, exactly when it says, exactly how it says, with exactly the size it says. You don't make decisions, your system does. You don't get credit for wins, your system gets credit. You don't take blame for losses, losses are built into the system. You just execute like a robot, without emotion, without deviation. This might sound boring or limiting. But that's the point. Sustainable profitability isn't exciting. It looks like this. You check charts at the same time every day. Takes 15-20 minutes. You see a few potential setups. Only one meets every criterion. You take it mechanically. Place stop and target exactly per plan. Close the platform. Don't watch it. Don't stress. At the end of the day, journal that you followed rules perfectly. Repeat for months and years. Your win rate hovers around what backtesting predicted. You end up profitable not because you're a genius, but because you executed a positive expectancy system with perfect consistency. Boring, yes. Profitable, absolutely. Let's bring this full circle. Long-term capital management had the smartest people, Nobel-winning math, and a system that worked. They lost $4.6 billion because they broke their own rules. If they couldn't survive it, neither can you. The uncomfortable truth is, your strategy probably isn't the problem. Your inability to follow it is. Every time you break your rules, you're gambling. And gamblers always lose to the casino. You need to be the casino. Follow your edge religiously. Trust the math over your feelings. It's hard, it's the hardest part of trading. But it's also simple. You either follow your system 100% of the time, or you don't have a system at all. So tell me in the comments, are you a system executor or are you still gambling? Drop your biggest rule-breaking excuse below, I read every comment. If this hit home, give it a like, subscribe to Trader Shastra for more no BS mindset content, and hit the bell so you don't miss the next one. Trade smart, stay disciplined. I'll see you in the next video.